Well, to the local markets now, which opened sharply higher ahead of the Reserve Bank decision to leave rates on hold at 2%. Bank stocks, miners, even energy companies were all up, though the ASX came off little. And the Australian dollar jumped 1/4 cent after the RBA decision and kept on going. It's up against all the major currencies. And fund manager Roger Montgomery from Montgomery Asset Management is with me now in the studio. And Roger, no change, the RBA.
Not a surprise. However, investors and particularly mortgage holders need to understand that the big four banks are going to raise rates on mortgages irrespective of what the Reserve Bank of Australia does.
Well, this is clear because it's already happened, you know.
And it will keep happening. And all they're trying to do is recoup the reduction in their return on equity as a result of the changes pursuant to the David Murray Financial System Inquiry. So the increase in capital that's required and the increase in the mortgage risk weighting ratios means that all of the banks need to increase rates on their mortgages or reduce rates on their term deposits in order to recoup the loss on their return on equity. And why? Because return on equity ultimately determines intrinsic value, and intrinsic value ultimately determines share price.
So we've got this decision from the Reserve Bank, presumably based on the sort of the improvement in confidence, business confidence in Australia.
Yes.
How confident should you be as an investor in one of the big four banks?
Well, I don't think we've got four big banks anymore. I think we have three big banks and the NAB. The NAB is a very different beast to the rest of the banks.
And in what way?
Well,
because that's quite a big call, I suppose.
Well, yeah, absolutely. But we believed at Montgomery that what we had was in the National Australia Bank was a pressure on return on equity as a result of overpaying for UK assets, which ultimately turned out to be duds. Now, the NAB's trying to get out of that. But what we've seen from their latest results is that, in fact, the domestic business is suffering materially. Net interest margins are down. We've seen credit growth diminishing. Their market share is suffering. And so they're really, really struggling against the other three banks. So where we used to just lump all four in together, I think it's right to actually separate the NAB from the big four and say that's quite a different proposition.
An alternate view might be that actually Andrew Thorburn is more on the front foot, and that Cameron Klein, if you like, didn't actually manage to achieve some of the big decisions like dealing with the UK, and now you've got somebody in there who actually is transacting and might push the NAB back on the front foot.
I agree with everything you've said, but what the latest results show is that it's the domestic business, not the overpayment of the international businesses that is suffering or putting pressure on the return on equity. Now, return on equity is vital, and you've got CBA really as the benchmark in Australian banking, followed by Westpac and then the ANZ. But a distant cousin is the National Australia Bank.
All right, overall, do you think, given the low rates that we're going to be living with for some time and indeed low inflation, that perhaps investors should be thinking, managing their own expectation about the returns that they would
absolutely.
need to have?
So it's fantastic that you asked that question because the last time US rates were at zero was in 1932. It took 20 years, 1952, before rates peaked again, and that was at 2.8%. And given what's happening in China, we may be in exactly the same position today.
All right, Roger Montgomery, thank you very much for all that.
Pleasure, Ticky.